InSource.
Morning.
And thanks for being here. And tell us a little bit about InSource, what you do, and how it matters to the people of the community.
Well, InSource is historical lineage goes back to 1922 with an agency that opened in the Grove. And we did a merger back in 97 of 3 agencies. And because there's 3 different names, we figured that you couldn't do with the 3 names that it sounded like a law firm. So we threw out the name and we came up with InSource. And by doing that, we became known in the community as InSource.
Yes.
I mean, we've been around forever.
By the way, and that's a very pleasant name in the sense that you feel inclusive in that, right? And imagine if it's called Outsource, right? But this is InSource. So it's a very, very good name, and it's easy to say. So InSource has been out in the marketplace for a while. And so what is it that you do?
We do all lines of insurance. We have a personal lines department. We have a commercial lines department. We have a benefits department. We're siloed that way so people have the expertise and they don't try to wear different hats. Maybe we have one lady that focuses on errors and omissions and lawyers legal, and that's all she does. Benefits is the same way. We have staff that does nothing but benefits.
And that's similar to in the construction business. You have a guy that does the roof, you got the guy, and just because you're in the construction business doesn't mean you know how to do a kitchen.
Exactly.
Or electricity.
Correct.
All right. So that's good that you've got that. So if somebody calls up and they need, let's say, some commercial policy, you can direct them to the folks in your office that handle commercial policies.
Exactly. For instance, I do commercial accounts, and if I'm doing a construction account, my client calls me and says, I need a surety bond for this job. I can spell surety, but I can't write it. But we have a surety department. So I just walk down the hall and I talk to Eddie, and I say, Eddie, call this guy.
So there are a lot of people that are very unfamiliar with surety bonds. And is that mostly for people in the construction arena?
Usually.
Yeah. So if somebody bids a job, let's say from either a private company or the county or the state or the feds, they have to put up some money.
Correct.
And why do they have to get this bond?
It guarantees that the job is going to be completed, primarily. Strangely enough, I have clients who build nice houses in the Grove and City of Miami and Pinecrest, and the county requires them to get a bond to protect the trees.
No kidding.
Yeah. We're insuring oak trees for $40,000 at a clip in case they happen to kill the oak tree. There's a bond to replace the oak tree.
Wow. Yeah. All right. So for the average person, all right, that works for somebody else, what are the different types of insurance that they typically have and things that they might want to look at?
Well, I mean, as an individual, you have your personal insurance. You've got your home, your auto, your life. Through the business, you may have health insurance, and hopefully you work for a company that does offer that. Then you've got short-term and long-term disability, some general life insurance that comes with the job. It's a minor amount. Some people I find depend on that life insurance as all their life insurance, and typically it's $10,000. It's not going to go very far. They want to get you buried today.
So let's talk about insurance on umbrella policies. Lots of folks don't know what they are, but let's talk about the homeowners that's not in business, working for somebody else, but they got, the kids are around and maybe they got some different little vehicles that are not necessarily, didn't need license to be licensed. Tell us about the umbrella policy, how it works and what it covers.
Well, think of an umbrella policy as shelter over your regular policies. You've got your home policy, you got your auto policy. I'm not going to talk about toys right now. Toys are another issue all on their own. Your home's got to have $300,000 of liability coverage for slip and falls and things like that. You could knock somebody over in the grocery store with your shopping cart by accident and injure somebody. That goes to your homeowners. Most people don't realize that once they get out of their house, there's actual coverage beyond their property line. Your auto insurance, typically most carriers for the umbrella require that you carry $250,000 of bodily injury and a $500,000 per accident. So that's more than one person. and $100,000 for property damage. And most people will say, well, why do I need $100,000 for property damage? Just look around the cars on the street.
You're about to tell us.
I mean, how many Maseratis and Ferraris and Porsches, and they all have six-figure price tags.
Yes.
So if you happen to total one or have multiple cars, you're going to need $100,000.
My brother gets a new car every 2 weeks, and he writes about it.
Yeah.
Some of those cars are like $190,000, $200,000, $250,000, and they look like just regular cars.
Exactly.
Right? And they're stunningly expensive.
Right. And again, I was driving to the beach one day, and there was three cars. There was a Porsche, a Ferrari, and a Maserati block, basically the three of them in front of me. I said, that's Miami.
Yes. So there was a car accident up north in the snow and everything, 100-car accident. Unfortunately, some people died in that. Put aside the personal losses for them, but the vehicular damage, when there's 100 cars that are really messed up, that's millions of dollars.
Exactly.
Many millions.
Yeah, and it's going to be hard to determine in that situation, how many people are technically at fault, because they're driving on ice and, you hit, so it's kind of like the domino effect of claim behind everybody behind them. The one with the biggest problem probably is those truckers, because they do a lot of damage.
Yes.
And that's why they're required to carry higher limits of liability.
Okay, so back again to the umbrella policy. Umbrella policy is above and beyond your normal coverage.
Correct. So it sits above. The question I get is, how much should I have? And it really depends on how much assets are you protecting, and can they be gotten to? You don't want to just throw your hands up and say, I'm not worried about it. But the umbrella limits start at $1 million and they go up. I have clients with 10 million, 15 million, 20 million.
So this is beyond their typical policy.
Correct.
And the reason that it's called an umbrella policy, because it can cover a whole bunch of things, right?
It's over your other policies.
And that could be umbrella policies on cars, on your home, right?
Motorcycles. The problem is when you get into things like that, if they're not licensed for the road, they typically don't have insurance. So they don't have any underlying coverage. So there's a lot of those things out there that aren't covered.
So let's talk about these fellows that hook up a trailer to their vehicles. Are those named specifically in their insurance policies, or do they just take a chance?
No. The trailers, if they're under 2,000 pounds, are automatically covered under the auto policy. So then they're also covered under the umbrella, since they're covered under the underline.
So the typically a umbrella policy is a way to go versus raising your limits for, let's say, for your auto.
Correct.
If you raise your auto limit,
well, you can raise your auto limits above the 250-500,
right,
but it's typically cheaper to get the umbrella.
Yep. Okay. And if somebody owns a bunch of apartments and they can buy the umbrella policies, would that be one policy if they own 3 or 4 different apartments and rent them out, or do they have to? So that's a really good way to go, it sounds like. And you brought up about long-term care. We are all living a little bit longer, and it's getting more expensive. So let's talk about long-term care costs, and if available, what's the sort of range for that?
Well, to buy long-term care coverage by itself today is getting prohibitively expensive. When the policies first came out, let's say 20 years ago, you could buy a policy for $1,000.
$1,000 per
year. And it would cover, the typical costs. But long-term care is getting very expensive. If you were to go to the Palace, which is a well-known name here in South Dade, you could be spending $250 to $300 a day to stay there. We're talking $7,500 per month, 90-something thousand per year. Most people don't have that kind of money, and the insurance companies know we're living longer. The typical stay in a nursing home is usually 2.5 to 3 years, whether you're male or female. If you've got Alzheimer's, it could be 8 years. to 10 years. So today what we're recommending is there's life insurance policies that have a long-term care built into it, that you can use some of the policy benefits for death.
So is that normal, or do you have to order that specifically?
A lot of carriers today build it in. You don't even have to ask for it. But it's a good question to ask if you're being quoted a policy. Does it have any?
So if you had a life insurance policy, let's say for $500,000, and you wind up in a nursing home, all right, if you have it, they could take part of the proceeds and pay for that.
And there's also annuities that do the same thing. I kind of like the annuity aspect because some of the annuities are built that if you don't use it, you don't lose it. Yes. So you can get the money back. And the policy also grows.
So what's going on with commercial business policies as far as their liability and the structure coverage?
Well, we've had many years of what we call flat increases. It has been a very soft market. This past year, the market is flipped and become a hard market. And when we say hard market, that means the rates are going up. 2020, the average rate increase on property, we're talking globally, was 24%.
On commercial property?
Correct. South Florida is seeing a lot of, when you have an average, you can have 0, you can have 50, or I guess 48 to get 24. South Florida, where you're seeing the 24 to 48, depending on the construction of the building. And when I say construction, when it comes to commercial buildings, you have buildings that have wood truss roofs, which are just like a house. They are the hardest to insure because they're wood truss. Then you have metal roofs and you have concrete roofs. Naturally, concrete are considered wind resistive, so they're getting the least rate increases and easiest to insure. Give you an aside, we were just talking yesterday. Somebody has a house on the bay in Gables Estates. For whatever reason, has not had a mortgage, and now they want to get a mortgage for $5 million. Nobody in the personal side wants to insure it. We had to go to the commercial market. We got one quote. Actually, we got two quotes. One was for $105,000. One was for $200,000. Just for wind insurance, $5 million on a house.
That's pretty pricey.
Yeah.
That issue, and that's obviously not just for that one, but for all the homes that are there that are that amount of money. That's what the range is.
Very steep. Well, again, this house is older. It's not fully mitigated, so it's carrying more risk. Home insurance is another area that we're seeing huge increases this year. And that goes back, if you go back 3 years to Irma, we've had a series of storms hit Florida, and it's not just Florida. They hit Texas, they hit the islands. Insurance is global, so we're seeing the rate increases come across globally.
When you say this year, 2021, or you're referencing 2020?
I'm talking about 2017.
Okay.
2018.
I meant as far as the big increases.
Biggest increases. We've seen increases year over year over year. And it's just not the storms. I will give you, for instance, there was an article in the paper in Fort Lauderdale this past week about what to do about the insurance. So some of the things we're looking at is to stop covering your roof for replacement. If the house is if the roof is over 10 years of age, they want to give you actual cash value. The biggest
for what? Actual cash value
to replace the roof.
Okay.
So if you have a 10-year-old roof or 11-year-old roof, let's say, and it's $15,000 to replace your roof, or $20,000, and the lifespan of that roof is 15 years, they're only going to give you about 33% to replace the roof. You're going to have to come out of pocket for the rest. That's something being floated in Tallahassee right now.
So if your roof is, I don't know, $30,000, right? That's not an unreasonable figure for roof, right?
Right.
So you're going to get $10,000. The other $20,000
Your pocket.
you have to pay, and the premium to boot.
Right.
On top of that.
And the backstory to that, we've had such litigation on old claims. Right now, you have 3 years to bring a claim. So there's roofing companies that go door to door and say, I think we can get you a new roof.
I've heard those commercials.
Yes. And you've seen the billboards, you've seen the advertisements. Since 2015, there's been $15 billion worth of litigation towards roof claims and water claims. Of that 15 billion, 8% has gone to the homeowner.
How much?
8%.
8. And where's the rest gone?
21% from the insurance companies to defend the claims, and 71% to the lawyers that are bringing the claims. Because right now, if they get $1 more than that's offered in the claim, they can basically charge whatever they want. So we're seeing a $10,000 settlement to the homeowner with a $70,000 lawyer fee going to the lawyer.
So if you have a claim and you go to somebody else other than your regular insurance company, what I've been told is when you get your new insurance, they ask, did you have a claim? What was it? And did you use an outside, what do they call them?
Public adjuster.
Public adjuster. Why do they ask that question?
Because they want to know they got another potential claim coming sooner than later.
And that, does that count against you?
Yeah.
All right. And then so they say that might be the factor whether or not they're gonna insure you for the next year.
Correct.
And then so even though the public adjusters claim they get more money for you, does that really net happen?
It does in some cases. It runs a gamut of a little bit to a lot. Depends on how much they can shove into the claim.
And is there a real big difference between the insurance company coming out and them covering it? And let's say there's no hidden stuff. I mean, it's not like, they say, here's all the stuff that's wrong. And let's just say that's the case, right? That the money that you get from the insurance company, typically, is that enough to replace it?
In most instances,
Yes.
It is. And if it's not, you can go back and get a supplemental.
Yeah. Well, I had a case where it was one of the storms and blah, 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 the fence. I said, I forgot to show the guy another 50 feet of the fence. What can I do? He says, I'm just going to factor in as I did the rest of it. All right. Fine. It was perfect. It was nice and easy. All right. It didn't take a month. It was just, they were so glad that it was done. And I was so happy because I didn't want to have to wait for the guy and go through all the stuff. So that's what happened to be what I did. It worked very well. All right. And everybody was happy. So again, we see these ads on TV. All right. Have you had any damage to your roof and they've only patched it and you think you could get a new roof? It could raise, this is a commercial, the value of your house by $50,000 to $75,000, which at best is a little misleading.
Right.
Right. So when we see commercials like that and hear them, people should know that there is a cost ultimately that goes back to you.
Right.
Right. Somebody has to pay for that. And you may not be paying it today, but you're going to be paying it tomorrow.
Well, actually, that article that I was mentioning, they said that $535 on average is built into every policy just for litigation costs.
How much?
$535.
Okay.
On average.
So, all right. So we're down here with lots of storms. We have them all the time. All right. And I hate to say it, but the storm season it's never far away.
Right.
All right. What do the weather people say about our storms and storm surge and floods and all that? How do they factor that into our rates?
That all comes from the actuaries, and that's way above my pay grade.
Okay. So let's talk about flood insurance, right? There are places that are in the flood zone.
Correct.
And there are also places that are not. If you're not in a flood zone, you could still buy flood insurance.
Correct.
Right.
And that's non-flood zones. There's 25% of all claims paid by the flood program are in what they call non-flood zones.
Really?
Yes. So you think, well, I don't need it. The bank doesn't require it. I'm not going to pay the premium. There is a preferred flood policy available for these houses. and they typically are $500 a year.
Yeah. So years ago, I don't know how many, maybe 15 years ago, we have a mother's-in-law quarters. It was only like $200 a year.
Yeah.
Yeah. Yeah. Now it's 700. All right, for it. I am happy to pay it.
You're lucky to get it for 700.
Yeah, because we had two back-to-back storms that it was right below my knee for a week and a half. Went right up to the bottom of the toilet. Right, caused a lot of damage to that particular apartment. And we see there are lots of homes that are being built. I live in horse country, are being built up now, and I see that there's a $6 or $7 billion plan that Dade County might enter into with the Army Corps of Engineers, where Dade County has to pay about 35% of it, which is to mitigate some of the storm surge that could like ruin a lot of stuff downtown.
Yeah. So
let's talk about condo insurance on waterfront. Yeah, waterfront condo insurance. Tell me about that.
It's they're taking some big hits. We actually had one renewed, I want to say late last year, that went up 35% in premium.
So how is we as homeowners, business people, and people that are working for folks, how do we keep up with that, with those significant increases in costs for the insurance, and obviously what it costs to redo your house or your business?
Well, one of the problems is our houses are getting older, and there's more issues that come with that. And we're seeing, if you're not mitigating your house, you're paying for it in higher insurance premiums. And unfortunately, we have a situation of, I want to say, economics that come into play. Not everybody makes $1 million a year. They don't have the free cash to do stuff around their house they probably should do. But if you could put in impact windows, you can lower your premium. If you put up shutters, you can lower your premium. A new roof. If the roof is added since 2001, you get a big discount on your premium. But then again, if you got to shell out 20 grand, 30 grand to get a new roof, you're thinking, well, I'm only going to pay $1,000 more on my premium.
So, Phil, if you were a homeowner was looking for a new insurance company for whatever reasons, what are some of the things that a new insurance company wants to get from you as far as an inspection, whatever it is, from the homeowner before they're going to write that policy? What happens?
Well, it depends on the age of the house. Again, if it's built since 2001, they don't need a wind mitigation because they know it's mitigated by code. If it's older than 25 years, they want to have what's called a 4-point inspection. And the 4-point inspection, somebody comes and looks at your roof, looks at your electrical.
Somebody that's licensed to do that,
correct?
Which the insurance company looks at.
They're going to use it before they quote it. We got one right now, the house in Pinecrest. There was a little asterisk at the bottom of the plumbing that said cast iron piping,
which was put in
40-something years ago. Well, at this point, most cast iron stuff is rusting out and causing leaks. So that cut down the amount of carriers that would even quote it. We got one quote.
So you had mentioned earlier that the insurance companies might exclude an old roof from the policy.
Right.
But on that old roof, let's say the roof is damaged, but because the roof was damaged and the wind got inside, are they covered?
It depends on how the exclusion is written. It may just exclude roof damage. It could exclude all wind damage.
Because of the faulty roof, if you
right.
will.
Yeah, because even to get into the citizens insurance, which is the carrier of last resort, that 4-point inspection shows that the roof has to have at least 3 more years life expectancy. And if you get one that says it's got 3 years, Citizens will write the policy, but they'll non-renew it the next year because it's no longer got 3 years of life expectancy.
Never ending. You want to be a homeowner, go ahead. So besides insurance, you do other type of financial instruments. So tell us a little bit about that, Phil.
Well, I decided 6 years ago to kind of put on another hat as I was getting closer to my own thoughts of retirement. And I wanted to get educated for my own self-needs because like everybody else, we went through 2008, 2009 when the market dropped, felt like it went off a cliff. I wanted to make sure that that didn't happen again to me. So I went out and got the RICP designation, which is a retirement income planner, and connected myself, got my licensing for financial services, and connected with a company called Virtue Capital up in Nashville. And through that, we offer money management, which is usually tactical. We call tactical money management. And we also have a bond program that I think pays better than CDs. They pay from 5.5% to 7.5%, but they are an illiquid bond. When you buy the bond, whether it's 2 years, 3 years, or 5 years, you must hold it for that 2, 3, or 5 years before you can cash it in. The only way out of it is death, disability, and bankruptcy prior to the term. So that's why it's called illiquid. It's not like a CD that you can go cash out early and take a little haircut on the interest.
Mm-hmm.
You must hold it. But with CDs paying, 0.01% or 0.5% or whatever it is, and you get 5.5%, it's attractive to some people.
So some people, depending on their risk tolerance, may do something that they want to be able to get their money back right away in case something comes up. If somebody's feeling really comfortable, they could do something longer term.
Right. And if they don't have that comfort, I just enrolled a guy this past week that he called me about the bond. And when he said, what if I want to get out of it? I said, you can't. So we put him into a standard program with a regular money manager that if he decides to get out, he can get out.
So there's something for everybody.
Correct.
Short term, long term. There's some people that do real estate. What's your take on commercial real estate or on apartments, homes, as far as purchasing for investments?
Well, they've always been good. Historically. In today's climate, with the pricing of the apartments and the commercial real estate here, you're looking at what they call a cap, 5 to 6% after you pay your expenses. If you are comfortable with a 5 to 6% rate of return, and you have appreciation for the property.
So let's talk about for the amateur investor that buys a commercial building, and let's say it's valued at $1 million, right? And that's what it's about. Everybody agrees it's $1 million. What sort of gross rental should they get, all right, before they go, hey, this is okay, more or less?
If you were getting $100,000 on that $1 million property, that's 10%. But then you've got your expenses.
Right.
So, you got to kind of back into it to see what kind of rent, what kind of rent are you getting currently, or what is it getting? What's your mortgage costs? What's your insurance costs? Your electric, your taxes, all that stuff. And then what do you have left over?
And so obviously that person could have a mortgage for $800,000, or they
Right.
could have no mortgage, right?
Correct.
So at what point should somebody say, you know what, return on this isn't very good, all right? I may get appreciation, but it's a real problem because it's always the leak is roofing. The roof is leaking. The insurance keeps going up. I don't know if I can pass it on to the customer. At what point, as far as the return, that somebody should look at some more of a passive investment that they don't need to do anything with it?
Well, the rule of thumb had been that if you could get a 4% return year over year over year, you could live out your life comfortably. Now that return from the market, they're saying is you're wanting to think about 2.7% of your assets. It's what you're comfortable with. Really, it boils down to you as an individual. I do have a rental property, and I'm netting about 4% off of it.
Yeah, and obviously what you hope for is when it's time to sell, you're going to go, gee, now I've had it for 10 years, and I'm going to get a little bit more than the 4. Maybe it'll be 7 or 10 or whatever
Right.
it happens.
That's what you're hoping for.
Yes. So I was with some very wealthy friends, a lot of money. And he says to me, Michael, how much time do you spend on maintenance on your properties? A week later, I went and replaced about 4 air conditioners that I realized I was spending so much time with the repair guys over and over and over again. And my life has been really good because I don't have to think about it now for many years.
Right.
Of course, you have all the other stuff. So what people want to do is changes throughout the years. Maybe when you're younger, you're going to be doing the repairs yourself. Then after a while, you're paying somebody $300 an hour to come out and fix your stuff. So let's look at today's market and let's look at down the road. Today it's 2021. We've just been through some tough times, right? What does it look like the next couple of years as far as the financial market?
Well, if I had a crystal ball, I'd probably be sitting on an island somewhere,
Yes.
and we wouldn't be talking. What I've read, and that's what I have to do is just
Yes.
read and listen to the people that I think are smarter than me.
Yes.
And the range is 7 to 8% this year is what they're assuming the growth will be. But until January 1st of 2022, we're not going to know.
Yes.
Who was right. That's why I like in some of the investments, we talked about life insurance earlier. Life insurance products today are great investment tools that people don't realize because they're what they call index universal life policies. And they're tied to an index, whether it's the S&P 500 or NASDAQ or some index. And there's a bunch of them. If the index is negative, your policy does not go backwards. They have a zero floor. A lot of times you'll hear people say zero is your hero because you don't lose money. That is not true. There are some expenses built into policy, so your cash value will drop a little bit, but it won't go negative 10% or negative 20%. If you go back to 2009 when the S&P closed down 37% for the year, you would be glad to get a zero.
Yes.
And I wish I had one of those policies at that time. So I didn't lose any money in the market. And annuities do the same thing. And the good thing about the life insurance policies, you can take loans out of the policy for retirement and they're not taxable. And that's another thing. Not to get political, but everybody pays taxes. And if you can get something that you don't pay taxes on, it's a good thing. And another good thing is your Social Security, your Medicare premiums are based on your income. The higher your income, the higher your Part B premium is. If you're getting a loan out of your policy, that doesn't count towards your income.
So let's say we had a 40-year-old couple, they're each making $65,000, $70,000, $80,000 each, and they're looking down the road to when they're going to retire, whenever that might be. If they were to stop working then because of some reason, right? How much money would they need to have in the bank, if you will, to produce the income so they could continue living on the same or similar level that they would?
Talking about at age 40?
Yeah, let's say he became disabled and he couldn't work anymore.
I would hope they had disability insurance.
Right. Oh, that's another thing, disability insurance.
Yeah. I'd have to put that into the computer and calculate. I couldn't even swag a guess on that.
So let's say they got to age 60, 65, and they were spending $100,000 a year on their lifestyle. They still had the cars and the house and all that stuff. The grandkids covered the house. How much they need in the bank in order to spend $8,000 a month on their lifestyle?
If we have Social Security at the same level we have today, and they wait till later on to collect, and you're talking about somebody that's going to retire, and their Social Security limit age is going to be 67 because it goes up based on your age or when you were born. And if you're after age 6, if you're born after 1960, it's 67.
And what if you're born before 1960?
If you're born before 1955, 1950 cutoff. I was born in 53, my cutoff was 66. But at 55 to 60, it goes up 2 months a year to hit 67. So everybody today is 66 plus. If you wait every year you wait to collect on your Social Security, whatever your amount is goes up by 8%. And I try to advise people, wait to collect your Social Security. And people say, well, what if I die? I'm not going to get anything. And, yeah, that's a risk you run. Hopefully you don't. But where do you get 8% a year guaranteed?
Yep.
Safe money. And it's like an annuity. So if it goes up $800 to $1,000 over those 3 to 4 years, that's money that you're going to continue to get every year some increase on. And to go back to your question, if you have a husband and wife, and I'm going to use an example, not 100,000, but they're living on 60,000, and not to be chauvinist, but the husband has a larger benefit than the wife because she stayed home, took care of the kids a few years, and so her account didn't grow as much. So he's getting 20,000 a year and she's getting 10,000 a year. Their lifestyle requires 60,000. So they got 30,000 from Social Security and they're taking 30,000 out of savings to get that 60 grand. As a married couple, their tax bill is very low because they're only taking 30 grand out that they're paying taxes on. He passes away. She steps up to his 20,000 as the widow. Her 10,000 goes away. She still wants 60,000 to live on. So instead of taking 30,000, she's now taking 40,000. She's now single, paying a single tax rate. Where their tax bill was $1,000 a year, it goes up to 4,000 and change.
Because she's single.
Right. So she's actually living on less than the 60,000. She's paying a higher tax rate. So that's got to be factored in as well.
So folks, make a lot of money, all right? Make a difference and
save some
and be healthy. So you, based upon the things you've read, it looks like this coming up year from a financial end is going to be pretty strong.
Yes, 7 to 8% is a good strength. I mean, this past year was amazing. I mean, we saw double digits across the board pretty much.
Let's talk about your involvement in local organizations. Your office is down south, all right, in Palmetto Bay, right? So tell us about
it's not that far as Dadeland.
Dadeland, South Dadeland Boulevard. I'm sorry. All right, we're on 88th Street, folks. All right. So, what are some of the business clubs and civic organizations you've been involved with over the years?
Oh wow! Started out, got involved with the Life Underwriters at South Dade. Ended up becoming president of that, and then they merged in with the Greater Miami program, and I stayed involved with Greater Miami for many, many years. Then one of our office guys, or one of the guys in the office, decided to move up north, and he had been on the local insurance agents for the property side. So they said, would you step in and take his place in the board? So I reluctantly did that. And 5 years later, I find myself president of that organization.
You must have missed a couple of meetings that got appointed.
Exactly. And as you know, we met through the Chamber South.
Yes.
And I got the Chamber South because of one of your salespeople.
Is that right?
Yes. He wrote me into it. And we joined the Chamber. And gosh, I don't know how many years I've been involved now, but I ended up being chairman of the Chamber.
As a matter of fact, Brittany was just here from Chamber South, and we said hello to her. So you've been involved many years, and in this arena, you're trusted by a lot of folks that are down here, right?
I think so.
I see some of your work on Facebook when you travel. I see some of those great pictures, and congratulations on being able, to do that. So. Right now, there might be some young person that's listening right now, and I'd like you to talk to them. They're 18 to 25 years old. Talk to them about their future, all right? And you can talk directly to them right over here.
Okay.
And just, let's say 30, 45 seconds.
Find a job that you really like. You've heard the story, find a job that you like and you'll never work a day in your life. And come June, I've done this 40 years. And I kind of fell in, I hate to say that insurance is an accidental avocation. There are a handful of schools that actually have insurance programs. But if you came through our office, the 40 plus people that we have in the office, there's one person left, I think, in our agency that actually took any insurance courses besides myself. It's, like I said, it's an accidental application, but it is a great application. So I would say check it out. It's not an easy business to start in. I started on a commission-only situation 40 years ago, and it was a struggle, but I survived. And once you get through that hurdle, it allows you the freedom to do what you want. I got to all my kids' recitals and sporting events and things like that because it gives you freedom.
And that's part of life, is finding things that you love, right, to do, and it's enjoyable. I have an old saying: we have a farm, animal farm, and I say a bad day at the farm is better than a great day at work, right? Because when you enjoy it, you feel it inside, and you're passionate about it, and other people recognize that about yourself. And I know you to be a happy person, all right, and successful in your field. So I want to thank you for coming today, Phil. And folks, if you need to reach Phil Lyons, you can reach him on InSource all over the internet. You can find them. And again, this is Live with Miami's Community News. I want to thank Tommy for producing the show, and we look forward to seeing you soon. Phil Lyons, thank you very much for being here.
Thank you for inviting me.